So now I want to talk about whole life. Whole life insurance is a permanent coverage. It does not expire like term insurance does. It lasts your entire life. There are different types of whole life policies. So first, to talk about a regular whole life, which is like a pay to age 100 whole life. Does not mean you actually pay to age 100. It just means that the premiums are actually spread out over the time frame of you being 100. Now, the way whole life works is it's a permanent policy that builds cash value. The death benefit is increasing. The longer you live, the more it's going to grow. So for example, if I was 30 years old and I bought a $100,000 whole life plan, by the time I'm 85, it'll be somewhere around $250,000 based on the growth. Now, that means that it's also built cash value. So let's just say in cash value, it has maybe about $100,000 to $125,000 in cash value. Cash value is an asset for you. You can borrow the money from the cash value. People are always going to ask me, people normally ask me, well, how long before I can touch the money? In a whole life plan, whenever the money is available, you can touch it. Of course, if we're thinking that a whole life policy builds cash value, let's say from age 30 to age 85, it took to build maybe $100,000 to $125,000 in this particular situation. That means that in the beginning years, it didn't have a lot of money there. So if you're looking to have $20,000 and $30,000 and $40,000, you need to wait a few years for it to get there. Maybe 5, 6, 7 years, maybe even 10 years to get to that, to get to those numbers. So the way whole life works is it grows over time. The cash value you can borrow from. When you borrow the cash value, you do not have to pay it back. But if you don't, there is an annual interest. And that annual interest, if your company is paying dividends, with not all life insurance companies pay dividends, but if it's paying dividends, then if your dividend is not larger than your interest, then it's going to deduct from your cash value. So you want to either make the interest payments, and if you don't make the interest payments, you understand that it's going to take more loans to pay for that difference. But the thing about it is if the cash value keeps growing and if the dividends become large enough in the future, eventually the dividends can actually pay your policy for you. So that means you will no longer have to pay the premium, because the dividends at one point are going to be, because they compound, eventually they're going to be larger than your annual premium. And at that point, the premium can be paid from your dividends, which means you will no longer have to pay the policy, but you will still have the benefits of borrowing the cash value, of the increasing death benefit, and of course the fact that it does not expire and you have it for your entire life. Now, some ways that people typically use a whole life policy: you can use it to create a tax-free retirement income, meaning in your retirement years, especially if you're somebody who buys a policy at 30 and sitting on this policy until you're 65, you're going to have built a nice amount of cash value. Now, to be clear, the larger the death benefit, the more the cash value is going to be, because the larger the face amount is going to grow. So if you have a smaller face amount, 25, 50,000, 75,000, you're not going to have the same types of cash value as somebody who purchases a $500,000 policy or $1 million policy. Now, to be clear, whole life is the most expensive type of insurance. So it doesn't mean that you cannot afford it. It just means that compared to the other types, you get less death benefit for your money. So you're not going to be able to, at age 30, if you were healthy, you can get $1 million term for maybe $30 a month. But if you're 30 and you're healthy and you're getting $1 million whole life, that still may cost you about $650, $700 a month. It is very different in the cost for the death benefit. But if you are looking to build an asset, to build cash value, to possibly have a tax-free retirement income in the future, then this is a good option to go for. Another way that people use the whole life is to pay for their kids' college, or to invest in real estate, or to invest in their businesses, because you essentially have built a pocket of money that you can borrow from whenever you need, and you don't have to get the approval from a bank. You don't have to find out, and it's a liquid asset because you can request for the money and get it immediately. Most companies, you can get it in 24 to 48 hours. So because of that, it's a very liquid asset, and it doesn't require approval for you to get it. It just has to, the money just has to be available for you to be able to borrow it. Now, that's for the Whole Life 100. There is a Whole Life that is a custom Whole Life. That means you get to pick the specified amount of years that you pay the premium. And what I mean by that is I can buy a 10-year custom Whole Life, meaning only for 10 years will I pay the premium. Of course, this is going to be much more expensive than paying to age 100 because they have smashed all the premiums into 10 years. But guess what else happens? My cash value is also supercharged, because now that I've paid so much money in just 10 years, my cash value has grew way faster, and so has my death benefit. So this is something that really helps for somebody who is trying to build money fast. A custom policy will work really good for you. It will build more cash value than going a regular whole life policy. Then there is also, and with the custom policy, by the way, you can do 10 years, 15 years, 20 years, depending on the company will determine the amount of years. Some companies even have pay to age 65, which just means if I'm 30, I'm going to pay the premium to 65. Still, with all of these policies, especially like pay to age 65, if the dividends are being paid and they end up being larger than your annual premium, they still will kick in to pay your policy, and you will no longer have to pay the policy because the dividends will pay the premium. The difference is, in these cases where you pay the policy premium up in 10 years, there is no premium due. So when the dividends are being paid to your policy and you have no premium due, all of those dividends are just going to your cash value, and they're not going to pay the bill. So when you're deciding on what type of whole life policy, it's going to depend on, one, what your budget is. If you have a specified period of time that you want to pay for this whole life policy. And then also it's going to depend on if you're trying to have a larger death benefit, or if your focus is cash value. If your focus is cash value, there are ways that we can structure these whole life policies where you have a lot more cash value and not focus so much on how high your death benefit is. So for whole life policies, remember there is a regular whole life that goes to age 100. There's even a whole life that goes to age 121, which is going to be even cheaper than the one to go to age 100. But of course, that means the cash value is built slower, the death benefit is built slower. And then there's something called guaranteed whole life. All right. Guaranteed issue whole life requires you to do no medical. Most companies, you do have to be 50 to get this policy. They only give you up to $25K for majority of companies. There's a few out there that you can get 30 or 40,000 for. The bottom line is there's a stipulation. The company either is going to make you wait 24 to 36 months, 2 years to 3 years to actually get the full death benefit. This is a policy you only want to get if you would not qualify to go through underwriting. If you are a healthy individual, you do not want to get this policy. If you have, health concerns and you wouldn't qualify for insurance, this is a perfect option for you. If you are 50 or older, there are a few companies, depending on, well, since the pandemic, not so much, but there were a few companies that were letting you get this policy prior to age 50. But the bottom line to it is the stipulation is you have to live for either the 24 months or the 36 months, depending on what company you go with. And not until you make it to that point will you get the full death benefit. Before that, you will get your premiums plus whatever interest that company is offering. So if that company offers 10% and you lived a whole year, for 12 months, if you were paying $100 a month, you would get $1,200 plus whatever the interest was that the company is paying. So it's not a bad idea, because people say, well, why would I want to get a guarantee issue policy if it's not going to pay? But what if first of all, the fact that you're still getting money in a bulk lump sum and you didn't qualify for regular insurance, you're still getting paid in a bulk lump sum when the person passes away. So that helps you. But also what it does is if you do make it to the 24 months or the 36 months, you get the full face amount. So guarantee issue, do not confuse it with regular whole life, because you will have people sometimes who will say, well, I bought a whole life policy and it didn't pay out. So you have to find out from people, what kind of policy, what kind of whole life policy did you have? Remember, there's a regular whole life to age 100. There is 1 to 121. There's ones that pay to age 65. There's ones that are custom, meaning we pick usually 5 years, 10 years, or even 20 years. And then there's also guaranteed issue whole life insurance, which means it's guaranteed. There's no questions asked. There's no medical that's required. And again, with that, you typically have to be 50. So understand the type of whole life that you have so that you can plan for your finances and for your estate planning.